You are going to invest some of your extra money. Again, money that you made from your job or your business that you didn't spend at Gucci, right? You take that extra money and you're going to put it into the stock market. Now, I'll go over what are the things that you can invest in, but some companies on the stock market have a lot of cash at the end of the year. They're making big profits and then they have all this cash in their bank account. And now this company can do three things with this cash in their bank account. I want you to understand the hypotheticals. Number one is they can take this cash and save it for an emergency. You all remember when COVID happened, a lot of companies had no money left over. Well, one thing that these companies can do is save this cash for an emergency. The second thing that they can do is take this cash and reinvest it right back into the company. They can open more stores, hire more employees, invest in the software, invest in the technology. But the third thing that companies can also do is they can take this cash and give it away to the shareholders. They can just give it away to investors in the company, people like you, people like me, that own a share of these companies through what's called a dividend. A dividend is a regular quarterly payment, meaning it's paid out every 3 months that you get for doing nothing except owning the company. If you invest in a company that's paying a dividend, that means that this company is going to pay you money. They're going to deposit money directly into your brokerage account every quarter, meaning every 3 months, for you doing nothing except owning the company, because now you own a piece of the profits, and this company says that they're going to give away the profits. Not every company pays a dividend, and not everybody wants to get a dividend. Before I get into the pros and cons, let's go over how this works, and then I'll talk about how you can actually win with this strategy. So make sure you stick with me through this entire section, because I want you to understand the entire process on how you can win. The first question everybody asks here is, okay, Jaspreet, I want to get some dividends. What company should I buy? Well, there's two different routes that you can go down. You can either go out and invest in individual companies, stocks, or you can invest in funds that give you exposure to a lot of different companies. So let's start with stocks. Everybody will say, well, what stock should I buy? And it is going to be way too much for me to explain how to analyze a company, how to read the financials in this video, but let me go over the basics of how you can start. Just go to Google and search top dividend paying stocks, and this will give you a starting point on your research. Morningstar put out this article going over the 10 top dividend paying stocks, and the top 3 are number 1, Verizon, number 2, Johnson & Johnson, number 3, the Altria Group. Now, I got to give you the disclaimer. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money, which is why you need to always do your own due diligence and never, ever blindly trust a random guy on YouTube. So the 3 companies that we're going to be looking at right now are Verizon, which at the time of recording this video is paying out a 6.5% dividend. Johnson & Johnson paying out a 3.3% dividend, and Altria paying out 8.3% in dividends. Now, the way this works is if you were to go out and invest $100 into this, and this company, what that means is after the next 12 months, you would make 6.5%, meaning $6.50 in cash flow deposited into your bank account for your investment in Verizon. You would make $3.30 for your $100 investment investing in Johnson & Johnson, and you would make $8.30 investing in the Altria Group. The first thing you're going to say is, Jaspreet, that's not a lot of money. Stick with me, I'll explain how you can increase your returns. The second thing that you're going to say is, Jaspreet, okay, if this is the case, then I should invest my money here because I'm going to get the best and biggest cash flow, right? And that's not how you want to do your analysis. Now, I know I'm not going over how do you actually research a company in this video. I'll link a video on how to do that down in the description. But what you want to understand here is this is just the cash flow. What you are investing in is this. You are investing in the company. You are investing in the underlying asset. And the last thing that you want to do is make your investment decision based solely off of this, because this does not tell you necessarily the true health of the company. For example, if we take a look at the Altria Group over the last 5 years, what you'll see is that the stock is down almost 10% over the last 5 years. So sure, they're paying out this 8.3% dividend, but what you really want is a company that's growing in price and also growing in dividends. And that means you want to be investing in a good company that's growing and innovating with growing profits. And you might say, but Jaspreet, I don't know how to do that research, or I don't want to do that research. Is there a way for me to lower my risk? Because you also have the risk that you put your money in Verizon and then Verizon goes bankrupt. Now, not only did you lose your cash flow, but you also lost all the money that you invested into the company. So how do you mitigate some of that risk, especially for what I call the 98% of Americans who should not be investing in individual companies? Well, that's where we have the right side, taking a look at funds. Here are a few examples, keyword examples, not telling you what to invest in. SCHD, This is a fund created by Charles Schwab, or now known as Schwab, which invests in high dividend paying companies. And this is paying out a yield, a dividend of 3.4%. Number 2 is SPYD. This is a fund created by Spider, SPDR, which invests in dividend paying companies in the S&P 500. The S&P 500 is a group of the 500 largest companies on the stock market. So if you take a look at these 500 largest companies in the stock market, some of them pay out dividends. This is investing in those companies that are paying out dividends that are part of the S&P 500. Then you have VYMI. This is a Vanguard fund that invests in international high dividend paying companies. These are companies not in the United States that are paying out high dividends. And then you have FDVV. This is a high dividend fund created by Fidelity that's investing in dividend paying companies. Now, what does all this mean? These are funds created by different companies: Fidelity, Vanguard, Spider, Charles Schwab. All of these are different institutions. You might have heard of these in different contexts. These are institutions that create funds that then go out and invest in companies. So now when you invest in any one of these funds, you're not investing in one company like you would here. You're investing in dozens or hundreds, or in some instances even thousands of companies. That way now you can lower some of your risk, because now let's say you invest in one of these funds and a company like Verizon goes bankrupt. In this instance, if you put your money in Verizon, not only is your cash flow gone, but your investment is gone. Every dollar you invested is now zero. Here, if one of the companies in your fund goes bankrupt, well, you're still okay, because you have some winners to balance out the losers. That's why in general, you might see lower returns, but you're also lowering some of your risk. So if you're thinking about now, how do I just set up a system where I can just keep investing my money and not have to invest so much of my time and energy making sure that the company I'm investing in is a good company, a fund can be a good example. Disclaimer, these stars mean that I have some of my own money invested in this fund, so VYMI and SCHD. This is where things get interesting, because most people who now are interested in investing for cash flow, who want to invest in the stock market, might get this far, but then they'll not do anything else. This is where most people's research stops, and that's why most people end up losing in this game. So now let's take it one step further as to how you can actually make some real money when it comes to investing your money for cash flow. So I'm gonna wipe this off and we're gonna go a little bit deeper. The reason why so many people end up losing at this type of dividend investing game is because they look at the numbers today and then they don't take any action because of what they see from the numbers today. So let's assume that you can invest in some sort of thing on the stock market, a fund or a stock that's going to pay you a consistent 4% dividend. Then what people say is, if I can invest $10,000 today, which is a lot of money, that means I'm only going to make $400 a year from my investments. That's not a lot of money, especially if you're eating at Five Guys. You're not going to get a lot of cash or a lot of outcome out of it, because $400 is not going to change your life. If you invested $1 million of your own money today, that means you're going to be making $40,000. It's a lot more money, but still maybe not life-changing money. And this is where people say, well, why should I even start? I don't have $1 million. I could put in $10,000, but it's not going to really make any difference in my life. And this is why most people don't do anything. And this is where most people get this whole concept of dividend investing wrong. Because the way that you really generate cash flow is you have to look at it as a long-term gain. Because if you look at it as a long-term gain, you can really now maximize and accelerate your returns if you are willing to invest your money for the long term. And let me show you what I mean. Let me just lay out the foundation. If you want to make a lot of money in cash flow, passive cash flow in the stock market, you have to have at least, at the very bare minimum, a 10-year investment span. And the reason why is because the first 3 years of you investing your money, you're going to get no returns. It's going to feel like you're getting nothing. And that's part of the process. And that's where most people will completely give up. 90% of people will not make it that far because they can't think 3 years ahead, but you have to think 10 years ahead. The first 3 years, you get nothing. Then the 3 years after that, years 4, 5, and 6, you're going to make a little bit of money. Nothing life-changing, but a little bit of money. But still, not that much to really impact what you're doing. It's a little bit more than what you got the first 3 years, but it's a little bit more. Then the next 3 years, year 7, 8, and 9, it's a little bit more money where now you're starting to see that, oh, I'm getting a decent sized dividend check. It's something that I could take this money and actually go out and use it. I can actually go out and buy something. I can actually start using this money, but you don't do it yet. Then by year 10, what you'll see, if you stay consistent, if you do the things that I'm going to show you, that's when you start to see some actually significant returns. And that's when now you have the option where, okay, I see this process now. It's finally starting to work, but it took me 10 years to get here. If you're not willing to do this for 10 years, you're not going to see any returns, and most people don't have that type of mindset. But let me show you why it actually works if you're willing to invest your money for 10 years, because there's a couple things that happen. Number one is assuming you're investing your money in a good asset. What you want to see happen is you want to see the stock price grow. You want to see this investment value grow. And as this company starts to make more money, guess what else happens? They start to pay out bigger dividends. So now, you started buying the company when it was this big. And then when it becomes this big, you start getting the bigger dividend checks. I know I'm showing you this from a theoretical example because that's the best way I can kind of visualize this. When you buy a company here, you're going to get this size of dividends. When you own it here, you get this size of dividends. But this is the thing. You got to let your dividends and your investment time to compound and grow. But you don't just want to buy it once. You have to keep investing your money. That means here you're going to buy, 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 and here you're going to buy. And then every time you get paid, every time money comes out, every time you get the quarterly check, every time those dividends hit your bank account, you want to take this money and reinvest it to buy even more. So every month, you take some of the money, this active income that you're working to make from your job or your business, you're going to take some of this money, buy some of these dividends. Then every quarter, when you get that dividend check, you reinvest that to buy more dividends. So you're working to buy more cash flow, your cash flow is working to buy more cash flow. It takes time because now you got to keep stacking how much money you invest, and you got to keep stacking the money that your money made, and then you got to also stack the investment, letting this money that you invested in grow, that way you can make more money. That's how you let your money compound and grow, because it takes time for this investment to grow in value. It takes time for your investments to go into here, and it takes time for your cash flow to actually grow. To put this in perspective, let's assume that you go out and invest your money into this asset that's worth $100 today, and it's paying out a 4% dividend yield, meaning you're making $4 for every $100 that you invest. Well, what we've seen happen over the last 10 years is that the S&P 500, the stock market, has grown by around 265%, which means if we follow these numbers, what we saw over the last 10 years, that means that number one, if you invested into something that grew at the rate of the stock market, it would be worth $265. But remember, you're investing for cash flow. So what does that mean? If we assume that this company continues to pay out the same 4% yield. Remember, it was a 4% yield here. If they're making more money, making bigger profits, maybe they can still pay out that 4% yield if they haven't increased it. If they're still paying out the 4% yield, that means this company is now paying out over $10.50. That's actually $10.60, but I'm going to keep it round here. $10.50, which means you're also making 2.5 times more in dividends for every dollar that you invested. But this is the interesting thing. In the beginning, when you invested the $100, you're getting a 4% return on that $100. Now, that same $100 is generating $10.50 in cash flow, more than a 10% return 10 years later. That's the power of now, number one, investing into a good asset, and number two, investing your money for the long term, because you got to keep investing your money here, 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 every week, every 2 weeks, every month, that we can keep stacking your ownership. Now you might say, well, Jaspreet, what's the guarantee that I'm going to invest my money into something and it's going to be worth more money in the future? There's no guarantee. Remember what I said a minute ago or a couple minutes ago. Investing has risks. That's where your financial education comes into play. That way you can hopefully find a good asset to invest in. But one of the ways that you can lower your risk is by, number one, investing into a fund, and then number two, investing your money for a long-term horizon, because the longer you invest your money, the lower your risk becomes. But this is where you got to know your game, you got to know your goals, and you got to know how you're going to win in that game. And this is where your financial education is so important, which is why you have to, if you want to find a good investment, have to invest in your own financial education. Don't blindly follow what somebody else does, because what works for me might not work for you. You have different goals than me, you have a different risk tolerance than me, and you have a completely different game plan than me, which is why you got to find what's right for you, and why I want you to understand the trends and what's happening in the markets and keep up with the financial markets. That way you can find a winning system for you. By the way, for those of you that do want to stay up to date on what is happening in the financial news, when it's happening, my team at Briefs Media, my company, publishes a free daily newsletter called Market Briefs, where every day my team's working to break down what's happening in things like the economy, the housing market, the stock market, crypto, and the global economy into a fun, witty, and easy to read newsletter. If you want to read it, it's completely free, and I got the link for you down in the description. below. So to recap, the way that you win in the stock market, if you want to generate cash flow, this type of passive income, is you got to have more time, you got to have more money, and you got to have the consistency. That means number one, time, you got to let your money compound and grow with the markets. Number two, you got to keep investing more money. That means every week, every 2 weeks, every month, you got to stay consistent, whether the market's up and down. You got to stick with it, assuming you have a good asset. And number three is you have to stay consistent. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.